Things that seems really interesting to me is if you talk to maybe like a Jeremy Grantham. I was reading something this morning, a couple of days ago. He was talking about, if every metric from the equity side were overvalued, there should be a market correction. Kind of this time isn't different. But when you look at things like the quantitative easing or the Fed's actions, it seems like it is different, right? And so how do you kind of balance those two things between what I would consider more fundamental analysis in whether it's equities, commodities, et cetera, and people who have been those value investors or around for a long time? They're like, look, this is the same thing as the 2000 crash or the 2008 crash. It's just a matter of time, versus the school of thought of like, no, the response is different. They're willing to do things. It's almost like they've banned market corrections and outlawed bear markets. Could both be right? Is one side going to be kind of overwhelmed by the other? Just how do you think about balancing those two perspectives?
Yeah, I think both sides have merits. And, it's been part of my research process where for years now, I mean, that's the challenging thing about valuations. People could say back in 1997 that valuations were heated, and then for 3 years, it just went higher and higher, higher to the dot-com bubble before correcting. And by the time it corrected, it didn't really get much lower than the initial points where people started pointing out how heated it was. And so, things were heated in terms of valuation a few years ago, and they've only got more heated since. And so actually, it's part of my research has basically been saying, hey, a lot of things are overvalued. Here's why I'm still in equities. And so far, that's been the right decision. And partially it comes down to comparisons. And so in the dot-com bubble, for example, treasury yields were like 6%. And so the equity risk premium for owning equities towards the end of that cycle was disastrously bad for equities. It was a clear, much better risk reward to go into a treasury yielding 6% compared to how low dividend yields were in the S&P 500, how high the valuations were, how low the earnings yield, you could call it, cyclically adjusted earnings yield, all sorts of metrics. But by every metric, it was, equities were kind of silly. The challenging thing about this cycle is that by most metrics, equities are very overvalued. But at the same time, treasury yields are super low. And so when you're estimating the forward return of stocks versus bonds over, say, a 10-year period, that's actually less clear than it was, 20 years ago in that bubble. And so that's one of the challenges that investors have. That's why some people call it the everything bubble, because in the dot-com bubble was specifically a stock bubble. Real estate was not silly priced. Bonds were not silly priced. In this environment, stocks, bonds, certain parts of real estate, kind of across the board, there's pretty high valuations. And generally the areas where there's not bubbles, in my opinion, are, say certain commodities like energy sector. I mean, that's been in a multi-year bear market. Like literally, energy stocks are in like more than a decade-long bear market. I think the healthcare sector is not really in a bubble. Basically, there are pockets of the market that are reasonably valued, but the overall index as a whole is quite valued. And so it just comes down to weighing that risk versus the risk of owning currency that's getting devalued. Because one thing that makes this cycle different, again, is that this is the, kind of the towards the end of a long-term debt cycle. And so we have to go back to the 40s to really find a fiscal and monetary environment that looks like this. And so basically, usually if you get inflationary pressures, the Fed raises rates and does other activities to try to contain that. But basically what made the 40s different was that you had massive inflationary pressures, but because debt was so high and those U.S. fiscal deficits needed to be financed for an external catalyst, obviously the war, they just held interest rates low anyway and just let cash and bonds basically burn away. And so I think the 2020s are kind of shaping up to be that sort of environment. And we're already seeing it now where inflation is 5% at the current time, while treasury yields are, last I checked, like under 1.3%. And so that also applies to cash in the bank. That applies to, T-bills are even lower. And so I think this is going to be an environment for the next, more often than not for this decade that yields for cash and bonds are going to be below the inflation rate. And so you have to kind of pick other areas and just try to avoid things that are obviously bubbles, that are euphoric, that are overvalued, and focus on companies or assets that you feel like you have an edge in and that you think will be higher 5 to 10 years from now.